All righty, and we are live. Happy Thursday. Welcome to a Lunch and Learn with Purse Strings. We are into March, so we're talking all things different investing and different purchases and things like that. And real estate can be one of them as well. And we are talking today all about reverse mortgages. But for those of you who are new to Purse Strings, we're all about tips, tricks, pieces of advice to help women be financially fearless. And then when you're ready to, do a reverse mortgage, or you're buying a house, selling a house, getting married, getting divorced, whatever that is, and whatever financial professionals you need, we have financial professionals willing, ready, and able to serve you. We call those our Purse Strings approved professionals, and Bruce is one of them. So we're so excited to have him on today. Bruce, before we get started into reverse mortgages, could you give a little intro of who you are and what you do?
Absolutely. Again, my name is Bruce Bufe. I've been in the mortgage business now for 30 years. So apparently this is what I do when I grow up. And so I've been doing regular mortgages most of the time. My first reverse mortgage I did was actually for my mom in 2004. And it worked out and was a great product for her and her situation. So I've become pretty passionate about it. The older I get, more and more of my clients are going to fall into this category. So I think it's a great alternative, and not only just as a mortgage, but as a financial tool that you can put in your toolbox with all your other products that you have and ways to manage your money. So it's great. But I'm in the Chicagoland area. Our company's licensed in 50 states, so we're good with that. I'm licensed in 23. The ones I'm not licensed in, I can get licensed in, so not a big deal. We can take care of you wherever you need to go. So awesome. That is what I do.
Well, we're excited to have you on and talk all about reverse mortgages. So I know you said you first, did this with your mom for her home. So what is a reverse mortgage, just to get started?
Sure. Yeah, absolutely. The $1 million question. So most of us have forward mortgages, if you want to call it that, or normal mortgages, where you make a payment each month and your principal balance goes down. So I'll give you an example. If we had a $100,000 loan, and your payment is $1,000 a month on a regular mortgage, you make a payment, now you owe 99. You make another payment, you owe 98. Reverse mortgage is just the opposite. You don't make a payment, okay? And if you owe 100,000 on your reverse, and that payment theoretically would be 1,000, instead of making that payment for 1,000, it actually gets tacked on to your mortgage balance. So instead of making a payment, now you owe 101. You don't make a payment, you owe 102. 103, and so on and so forth. So as you can see, over the life of the loan, what happens is that payment is accruing on your principal balance. So at the end of the loan, you're going to owe a lot more than what you started with. But in return for that, you don't have to make a monthly payment. So that's kind of the nuts and bolts of a reverse mortgage and how it works.
So you're taking out more on the loan, but you don't have to pay monthly. Exactly. And so who is this, a good fit for? Can anybody do this? Because it sounds a little backwards.
Yep, absolutely. So you have to be 62 years old to do this, to qualify for one. So the thing that's really nice about it is if you have your house paid off, great. And at age 62, you're probably going to be able to have access to about 35% of the value of your property. Okay. So if your house was worth 100,000, you could take a reverse mortgage out for 35,000. You can access that 35,000 in one of three ways, or a combination of all three. So you can take a lump sum out and have that money at your disposal to use however you would like. Okay. And again, you're not making a monthly payment to repay it right now. You can do a line of credit, so you can draw on it as needed. Okay. And then the third way is you can annuitize it. So you could get a monthly cash stream or flow of income every month to do that. So those are the three ways that you could access those funds. Okay. Now, that's assuming you own your house free and clear. If you have a mortgage, okay, you can use a reverse mortgage to pay that mortgage off, thus eliminating the mortgage payment. So I'll give you a quick example. So I had a lady who was getting $400 a month from her $100,000 annuity. Okay. Her reverse mortgage that she qualified for was basically only $300,000. She owed $400 on it. and her monthly payment for a mortgage was about $1,200. So in talking to the advisor, what we decided to do was take the 100 from her annuity, cash it in, pay the mortgage down. So now she qualifies, eliminate the mortgage payment at $1,200. So she saves $1,200 a month. She loses $400. So her net income increases by $800 a month. So
Wow.
a couple different strategies that we can use to maximize that. So you typically have to have a good amount of equity in your property to do this.
Okay.
So the older you get, the more access you get. So if you're 80 years old, for example, you're going to be able to access probably 50% of the equity. So again, if 100,000, you're going to have access to 50 at that point. So good news is they've kind of ratcheted that down so you can't take everything.
Right.
There's a good chance there's going to be equity in your property. The other thought is people are living a lot longer now. So, this is kind of like a life insurance product. There is an element of life expectancy in this determining how much you're going to be able to access. So
how do they kind of figure out how much you are able to access? Is that part of your age, part of how much you own in the home and things like that?
Yeah, exactly. So your age, your birthday, the value of your property, those are kind of the main components, how much equity you have in the property, based on if you have a loan or not. So we punch it in. It takes just a couple minutes to put together a proposal. It's really easy to do. And then it just spits it out and says, this is what you're, allowed to do. They don't allow you to pick and choose how much. They just give you, a certain amount, and then you determine how you want to access those funds.
And so we know at the end of the day, everybody wants to get their money back.
Yes.
And so how does this kind of work, either when the homeowner passes or they decide that, they're going to move or something like that, and they work on selling the house?
Yeah, no, great question. So you can be in the house as long as you want. As long as it's your primary residence, you're living there, you can stay in the house. Even if you run out of your money that you have access to, again, there's no repayment necessary. So using our example, if you had your $35,000, you lived there for 8 years, and now you can't draw anymore. That 35 is gone. Okay. Now you owe 120,000 because of the accrual of the interest over that time frame. And you want to move. You're going to go to assisted living. Okay. So you sell the place for 200,000. Great. Okay. So if it sells for 200,000, you owe 120,000. You get to keep the 80,000 in equity. That is your money. It doesn't go to the bank. A lot of people think the bank owns the property, and that's not the case. So equity is yours. If there's anything, proceeds from the sale, you get it, your estate gets it, you're fine. Now, if let's say you get, hip replacement, knee replacement, and you're in rehab for 6 months, which, my dad was. And so you're out of the house. It's not your primary per se right now. That's fine. You can move back in. But if you're out more than 12 months, then you've got to sell the house, because they kind of figure by then you're going to be needing assisted living or something. Then you've got usually 6 months to a year to sell it, and they want to make sure you're actively trying to sell the property. So you've got a little window there to do that. So the other thing is, this is another really fantastic feature about the reverse mortgage. It is a non-recourse loan. Okay. Meaning they can never come back to you personally. So whatever you sell the house for is what they have to take, regardless of how much you owe. Okay. So let's say you live to be 120 because you exercised and ate right and didn't smoke and didn't drink and didn't have any fun, but you lived to 120. So you now you owe 150,000 or 200,000 in interest accrual on your property, but you can only sell it for 100. So you're upside down. That's fine. Mortgage insurance kicks in and pays the difference. So your estate, your heirs are never responsible for any more than what you sell the house for. So that's
huge.
It's a huge, and it's a really great feature. So
yeah, definitely. Because that way, no one else is on the hook for it, which is great. It's not often that, houses sell for less, but if it happens, that way you are protected, which is great.
My mom, it happened in 2010, kind of right
that's true.
Crash. So
I
put this in 2004. She drew on it, used it. It was great. And then she had to go to assisted living in 2010. We were within about $3,000 where we're like, oh man, we might have to bring some, money to the table to offset that. So it was just comforting knowing that, hey, we weren't going to have to. because it was going to be taken care of. So.
And so do you need any different like house insurance or private mortgage insurance for that protection to kind of kick in?
Yep. So it's in the cost of doing this. So these loans are expensive. Okay.
Okay.
And when I say expensive, it's kind of a relative term. So the way you've got to look at it is to get this mortgage insurance. And let's just use 300,000 for an example as a value of the property. That mortgage insurance I just described that takes care of any shortfall that you may have is 2% of the value. Okay. That's due at closing. So $300,000 house, you're going to pay $6,000 for that insurance. Okay.
Got it.
Now, you're going to have closing costs or an origination fee that pays the bank or us, and that's on a $300,000, it's probably $4,000. Okay. And then you're going to have normal closing costs, which are another $3,000. So you've got 6 and 4 and 3. So it's about $13,000. And most people are like, Bruce, what are you talking about? This is insane. But again, you don't need to be working to qualify for this. It's a non-recourse loan, and you have access to your equity, and you're increasing your cash flow every month. And so what we've found is a lot of these seniors have, income of $3,000 a month. And if we can improve that by another $1,000 a month, that is huge when it comes to, net take home 25 or 30% more a month that they can take home. That changes their life. Like it did for my mom. My mom was like ecstatic that she could, have extra cash. She went to visit my sister in Tokyo and then, traveled some more and then had quintuple bypass. And then she was done. She couldn't travel anymore. She couldn't do anything. And so I just am very passionate about it because it frees people up to live life and do things that they really wanted to do. So,
which is awesome because that's part of retirement, is living it up while you can. You work so hard for that money and, paying for that house and these different things. So, we don't want to die with all the cash in our pockets and not living our life.
Yep.
And so this seems like a great opportunity because there is that bridge of like, if I had a little bit more, the anxiety would be, gone.
Yeah.
And you don't always want to pick up a job that's earning, $25 an hour, if that, when you're 80, that's not the option.
Yeah.
So this could be a really good option as well.
It's awesome. And the other part that's super, super important that I've talked to a ton of advisors about over the last couple of years is we've had that perfect storm. That perfect storm being that housing values is high as they've ever been. Okay. And then we had the market down 12%. So the other way you want to incorporate this in your financial planning is it's another bucket to draw from. Okay.
Right.
And that's super, super important because if you had $100,000 or say $1 million in your portfolio and it's down, 12% or 20% or whatever, and then you draw out income on top of that, now you could be down 20 or 30%, and it takes so much longer for that to come back. Okay.
Right.
And right out of the gate, if you just retired and in your first few years you have sequence risk, it's a really tough situation. If you can use the funds from your reverse mortgage, the likelihood of that coming back improves considerably. And every advisor's worst nightmare is having their client run out of money. I can't think of anything worse. That would keep you awake at night as an advisor. So it's really great that you can incorporate this, throw this in your toolbox, in your bucket, and draw from it at that time. And it just improves the likelihood that they're going to have money in the end.
Right.
So,
and what do you need to know about is there any tax things that you need to know about the reverse mortgage? There's always a tax.
God, it's like we talked or something. This is
I know.
Awesome. No, and so this is a great thing. So there's 3 types of tax-free income. Okay. First one, Roth IRA. Okay.
Right.
Don't tax. And then permanent life insurance. Okay. Second one. Third one, reverse mortgage. It's a loan.
Wow.
Okay. So you've got 3 types of tax-free income, and reverse falls in that category because it's a loan. So I have another client who lived out in Manhattan Beach, bought a house in the 70s, worth $3 million now, and you're like, holy cow. He's got an investment property, $3 million, same thing. No mortgages on either one of these. He's out of money. It's like, what am I going to do? Well, just sell the investment house. You're fine. The taxable event on the investment house with the capital gain was $500,000. Okay. So did a reverse on his primary, got his cash out to live on, When he passes, now you've got the capital gain starts at, today versus 1972 when they bought it. So
Right.
that taxable event diminishes considerably. So
Wow.
it saved him, $500,000 in capital gains because he took a reverse mortgage instead. So lots of different ways to incorporate this for tax purposes. So I'm glad you brought that up.
Yeah, that sounds amazing. So yeah, these are great things to know. Like you said, you have to be over 62,
Yep.
which, is an essential asterisk right there. But after that, this seems like a great option if you do need to open up some cash flow. And that's the thing, is there's always options out there. You just have to kind of talk and learn what they are, because there's always something. I promise you there's something.
And I'm always learning too. And I go to a lot of seminars and we talk about different ways that we can incorporate this and help advisors, help clients. And it's never ending. There's always something that's exciting. And I just think it's, again, a great tool to use for sure.
Definitely. Is there anything else that we haven't touched on reverse mortgages that you want to make sure?
Qualifying. Let's talk about income a little bit. So
okay.
Credit scores. I've had a couple clients that have had had one guy that had a first mortgage that he paid and a second mortgage he hadn't paid since 2016. So he was ready to go into foreclosure on his house because of the second mortgage he hadn't paid. You're like, this is crazy, because he only owed $180,000. His house was worth $560,000. So we were scrambling, got it figured out, didn't have a ton of income, but we were able to work with that, get him out of a pickle for back taxes. Another lady I had a situation where she owed $47,000 in property taxes. Her place was worth $350,000, no mortgage on it, but she couldn't pay her property taxes. We were within 2 days of the sheriff's sale getting that one done. Okay?
Wow.
So there's just all these different situations that arise that you got to do it. So income is not a big thing. Usually Social Security income and equity, we can convert that equity to income to help too for qualifying, but it's not like a traditional mortgage where you need a job and W-2s and 10 or whatever. It's very basic because they want to make sure that you can pay the property taxes, pay the homeowner's insurance, and utilities. So they use a factor to figure this all out. So it's very minimal. It's not like a regular mortgage for qualifying, but you do. A lot of people took these out and said, woohoo, no more payments. And they forgot to pay property taxes and homeowners insurance and ran into a pickle. So got to pay those though.
And that's a great point, because those are typically rolled into your mortgage, right? If you do a regular mortgage. So I can see how that would be easy to miss, just because you're used to having it all bundled and now you have these separate pieces. So that's a great point. So what, homeowners insurance and property insurance?
Absolutely. Yep. And that's the thing. If for some reason you were late on those and your credit's not that great, they do what's the equivalent of an escrow account. And it's called a LESA, LESA, loan estimate set aside. And it's the equivalent of an escrow account, but they kind of fence off a portion of the proceeds. So they use those to pay the property taxes and the home insurance. So there is a mechanism to help with that too.
Got it. So how is the market doing today? How is home ownership? Since I know you don't only just do reverse mortgages, but regular mortgages. So how are the homes?
Yep. What is going on out there? So it is slow for sure, because we've seen such high demand and so much going on in the last couple of years with rates being so low. It's kind of the normal cycle we're in. So it is much slower right now, but what we're hearing and seeing, it's been interesting. So our mortgage gurus in our market that talk about interest rates and what the economy is going to do are saying that, hey, we're heading into a recession. Inflation is starting to come under control. They think that's debatable. And rates were heading down. In the fall, they were up in the mid sevens. And then by the holidays and into January, we're down in the mid to low sixes. So we had seen some relief in that and moving in the right direction. But then we had the unemployment report last month, and it was the lowest since the 60s. So that spooked the market, and they were like, oh, geez. And then we had an inflation report that came in higher, and then they thought that, oh, no, we're not going to be able to ease. We're going to have to tighten maybe a little bit more. So there's a lot of uncertainty. Now, tomorrow is another big unemployment number that comes out. That will determine, I think, how we're going to move through the spring here. We thought rates were going to be in the mid to low fives.
Okay.
And we're heading that way. And then it turned around and we're up over 7 right now. So, we kind of gone back to where we were. I think there's a ton of pent up demand because people are just waiting on the sidelines. People want to buy houses. I mean, life moves regardless of what interest rates are doing. And that's what people have to understand. So they're out there. I had 2 weeks ago, there was 11 offers on one property in the Chicago area. So that felt like 2021. We're talking about different strategies. I was calling listing agents to talk to them to say these people are approved. I'm like, Jesus, maybe this is what the spring's going to be like. But now it kind of died off. So we have these fits and start, ebbs and flows, whatever you want to call it. But I think ultimately, between now and the fourth quarter, I think we'll see things settle down. Rates will start coming back down. And I think more and more inventory will come on the market. People will get out there. I don't anticipate a crash like everybody's talking to 8, 9, and 10. Way more supply. We don't have it. We're still 5 to 6 years away from reaching that equilibrium of supply and demand. So we've got a little ways to go from that standpoint. That's why I think we're still going to have an inventory problem, and there's still going to be, pricing that's going to stabilize and not crash like they're predicting. I think we're going to see it plateau, maybe go down a little bit, but inventory is still going to remain low for a while.
Awesome. I mean, that sounds pretty good so far. No complaints.
Yeah.
And so, if someone was thinking about working with you and buying a home, how often or how far in advance before buying a home do you suggest people come to, have a conversation?
Yeah, that's a great question. And I'll give another example of this. So I had a guy that was going to buy a house for $2.6 million. I was like, woohoo, big house. This is awesome. Pulled his credit. It was great. He went by, probably 60, 90 days. And they called me back, said, Bruce, we found something. We're excited. I'm like, okay, let me pull your credit again. His credit score dropped to 679. And I was like, oh my God, what happened? And I looked and it was a $110 collection. And I was like, what is it? Comcast? He goes, are you kidding me? He goes, that was my remote control. And they put it to collection. And I told him, I'm like, I can't do anything for you. If you want $1.5 million mortgage and your credit score is less than 680, I'm stuck. My hands are tied. So I advise people, number one, see me right away as quick as you can for something crazy like that, a parking ticket, a credit card that you opened up because you got a discount for opening it up and you forgot about it, like I've done. And so that's why it's super important. Get it done. Let's check it real quick. We'll look at it. People worry about hard pull versus soft pull credit, all that. It's not a big deal. Don't let that sway your decision to pull it versus not, because the credit pull impact is it's only 3 to 5 points. So it's not a big deal. So do it sooner. And then that way, if something comes up, we can address it right now. We're not scrambling. You haven't fallen in love with the house and you have to have it. And all of a sudden you can't. There's nothing worse than that. So sooner rather than later, we'll get our ducks in a row. I have people, I had a lady buy $20,000 worth of furniture a week before closing, and then she didn't qualify. It's the furniture or the house. What do you want to do? Take the furniture back, buy it later. So it's really important to do that. And then I can educate people on how to go through the process and make the transaction as smooth as possible. So sooner rather than later.
Awesome. Yeah, I love that. From doing these conversations and learning the things that you should not do and, 60 days right before you buy your house it's so funny and sometimes so backwards, because I could see being so excited to buy the furniture for your new home and have it, I could see the excitement, but that can really put a damper on things as well.
Yeah. And they think, oh, well, another thing to know is, Bruce, I got my approval. I'm all set. I just went and bought a car. And I'm like, no, we check right before. So you don't buy a car or a boat and now you don't qualify, and so we're pretty vigilant about it now and making sure people understand if you're going to do any of that stuff, you got to do it like 2 days after closing. That's fine. I don't care. Just don't do it 2 days before, because we always do kind of a soft check just to make sure they didn't do something. They still have their job. Yeah. Go buy a boat or a car, that kind of stuff. So sooner rather than later, we get them in the queue, make sure they understand the process, and that's how we do it.
Sounds like a big month getting a boat and a car.
People get excited,
Well, this has been a ton of great information. Is there anything else we didn't touch on that you want to make sure is shared today?
No, I don't think so. You've been great in asking all the great questions, leading me down the path. So No, I think we've touched on a lot of stuff. And if
Yeah.
there's something, any of the viewers have questions on, I am more than happy to talk. This is what I do, talk about mortgages. So
awesome. Yeah. So Bruce's email has been going through the bottom, bruce.bufe@dkmortgage.com. He's also one of our Purse Strings approved professionals, so you can reach out to him off our site, pursestrings.co. And like he said, get started early on these conversations, whether you're doing a regular mortgage or a reverse mortgage. So yeah, have these conversations early, and so you can be prepared. So thank you, Bruce, for coming on today. And yeah, don't be afraid to make a call and get the conversation started.
Awesome. Thanks, Maggie. I really appreciate it.
Of course. Everyone have a great day. Bye.
Bye.